Imagine if you could look at a company's income statement and quickly be able to tell if trouble was on the horizon. Believe it or not, but you can do just that in a few seconds by learning how to spot income statement red flags. In this video, I'll explain the 5 biggest income statement red flags, what they mean, and how to spot them quickly. Hi, my name is Brian Feroldi. I'm a financial educator who's been analyzing and investing in individual businesses for more than 20 years. Income statement red flag number 1 is a sudden revenue growth slowdown. If a company's revenue growth rate suddenly plummets, that indicates that there could be trouble on the horizon. Now, to find this, you simply take the company's revenue and divide it by the previous period. So you can look quarter over quarter or year over year. As a general rule, a company's revenue growth rate should decline over time, but the decline should be gradual. There shouldn't be a sudden spike. So when analyzing an income statement, you simply look at the company's revenue. And what you do is you compare one year's revenue to the next. In this case, this company grew its revenue by 10% in 2023 to $37.8 billion. And then the following year, the revenue growth rate was just 2.3%. That's a pretty serious decline in this company's revenue growth rate, and that could indicate that it's having trouble getting consumers to buy its products or services. I'm going to show you how you can use software like FinTat to track these numbers for you. If you simply pull up a company's ticker symbol, I'm going to use Zoom Video Communications as an example, and you scroll down and you click this button right here, this will show you the company's revenue growth rate from period to period. Notice that Zoom was growing at a triple-digit growth rate prior to 2021, and during the pandemic, its revenue growth rate skyrocketed 325%. Now, the following year, its revenue growth rate slowed to just 55%. That's a massive slowdown. And then the following year, revenue growth rate was a paltry 7.2%. When you see a revenue growth rate decline that is this severe, that indicates that the company is having huge trouble getting customers to buy its products and services. Now, if you look at this company's revenue growth rate decline and compare it to the company's stock price, you see that the market has been selling off the company's stock precipitously as it detected that revenue growth rate slowdown. And that brings us to income statement red flag number 2, a company's gross margin declining. What this indicates is that the company is generating less gross profit from each additional sale, and that could be to higher discounting for consumers to get them to buy, or higher supplier costs that the company can't pass on to consumers. Either way, if you detect changes in a company's gross margin, that's a bad sign. Now, to calculate this, you simply take the company's gross profit and divide it by revenue. As a general rule, gross margin should be steady, or even better, rising over time. So for this company, we would take the company's gross profit and we would divide it by the company's revenue. Now, if we do this math, we see that this company's gross margin was 31.6% in 2022. That number fell to 31.2% in 2023, and it fell an even further to 30.2% in 2024. Now, those changes might seem small, but even small changes in gross margin can indicate that there's trouble on the horizon. And if you see big changes in the company's gross margin, that is a huge red flag. Yet again, we can use FinChat to have this number tracked for us. So I'm going to show you an example using Beyond Meat as an example. We scroll down and we click on ratios and then margins, and we click on gross profit margin. We see that Beyond Meat had a gross profit margin of negative 39% in 2016, but this rapidly increased over time, peaking at 33.5% in 2019. Notice that the gross margin declined to 30.1% in 2022. That might seem like a small number, but it indicated that the company was having trouble with pricing its products to get consumers to buy. Gross margin declined further in 2021 and then have actually entered negative territory in 2022, 2023, and over the last 12 months. If you coincide this gross margin with the company's stock price, you see that Wall Street was giving this company the benefit of the doubt when it came public and its gross margin was high. But ever since the company's gross margin has been declining, shares have been an absolute free fall, and this has been a disaster long-term holding. That brings us to income statement red flag number 3, rising sales and marketing expenses as a percentage of revenue. If you see this happening, that means it's becoming more expensive for the company to acquire new customers, and that could indicate that the company's marketing efforts are becoming less effective over time. Now, to track this, we take the company's sales and marketing expenses, or selling, general, and administrative expenses, and divide this by revenue. As a rule of thumb, this number should be stable or even decreasing over the time as the company grows. If you see this number growing faster than revenue or taking up more of a company's revenue over time, that is a red flag. So for this company, we would take the company's selling, general, and administrative expense and divide it by the company's revenue. What we would find is that this company spent 22.2% of its revenue on selling, general, and administrative in January of 2022. The next year, this number jumped to 22.4%, and the year after that, this number jumped all the way to 24%. That means the company is having trouble attracting new customers in a cost-effective way, and the company has to devote more and more of its revenue to sales and marketing, which is a red flag for investors. Now, once again, we can use FinChat to track this number for us automatically, and I'm going to show you this using Peloton Interact. If we scroll down to ratios and then common size and then click SG&A to revenue, what we see is the company was starting started out spending 60% of its revenue on SG&A, and this number was actually declining over time all the way to just 33% in 2021. That was a great sign, and the stock was rocking and rolling. However, then demand started to slow down, and the company had to increase its spending on sales and marketing in order to spur revenue growth. That brought the company's SG&A number all the way up to 52% of total revenue, and it's remained high ever since. If you correlate this with the company's stock price, the market detected that its demand from customers was very weak, and the stock has been a train wreck for long-term investors. That brings us to income statement red flag number 4, a goodwill write-down. When you see this happening on an income statement, it means that the management team is forced to take a goodwill write-down, which is admitting that it overpaid in the past for a previous acquisition. Now, you can find this number by tracking a company's operating expenses, and as a rule of thumb, you don't want to see a company ever take a goodwill write-down. Now, to show you this happening, I'm going to show you the income statement of Teladoc Health, which took one of the biggest goodwill write-downs I've ever seen. In 2022, Teladoc Health was forced to take a $13.4 billion goodwill impairment charge against its profits. Now, you can easily track this number in FinChat by pulling up the company's ticker, scrolling down, and looking for the impairment of goodwill line item. Notice that this company's $13.4 billion write-off in 2022 just so happens to coincide with the company's share price continuing to fall dramatically, and the company's stock hasn't recovered ever since. That brings us to income statement red flag number 5, excessive dilution. If you see that the company's share count is rapidly increasing, that indicates that management is heavily diluting its shareholders. And if you are an investor in this business, your stake in the company is being diluted away over time. Now, some dilution is understandable, especially if the company is growing quickly, but you want a reasonable amount. As a rule of thumb, you want to see that a company's dilution rate is less than 3% annually if the company is growing very quickly, say more than 20% per year. And if the company is growing slowly, less than 10% per year, you want to see the dilution rate well under 1%. Now, a recent example of a company that was really diluting its shareholders heavily was Twilio. And if we look at the company's weighted average share count, we see that between 2020 and 2021, the share count increased by 18.7%. In other words, investors were diluted by 18% in that single year. If you look at the following year, investors were diluted by a further 5.1%. This is well above the 3% target that I have when I'm looking at companies that are in high growth mode. Yet again, using FinChat to track this is fairly simple. If we scroll down and click on weighted average shares outstanding, it will show us the share count year by year. Now, you could pull up any time frame that you want, and it will actually calculate the compound annual growth rate change in diluted share count for you. So in this case, between 2017 and 2023, Twilio shareholders were diluted by more than 12% annually. That is a sky-high number that indicates that Twilio does not respect its dilution rate. So there you have it. Next time you're analyzing an income statement, keep your eye out for these 5 red flags, and if you see them, that could indicate that trouble is on the horizon. Now, as I hope I've shown you, learning how to analyze a company's financial statements is absolutely critical if you want to learn to invest better. However, no two companies' income statements are exactly the same, and there's actually a lot of different terms that you could see used on the income statement or really any of the 3 major financial statements. To make this easy for you, I created a free ebook called Financial Statement School that has some of my most popular financial statement infographics in them. If you want a free copy, simply go to longtermmindset.co/FSS ebook or click the link in the video description. I hope you enjoyed this video. If you did, please give it a thumbs up. It really helps us out on YouTube. And if you want to continue learning, there's a 100% chance that you'll enjoy this video next.